Good morning, everyone, and welcome to today's webinar. My name is Alex Paul from InvestorStream, and I'll be your host today. Today, we have Happy Valley Nutrition Limited CEO, Greg Wood, who's going to be providing an update on the corporate and commercial developments of the company's state-of-the-art nutritional grade processing facility. Following the presentation, Greg will be available to address any questions you may have. We'll attempt to get through as many questions as time permits. Please feel free to send in your questions via the chat platform, in the question pane in the GoToWebinar control panel, or simply email them to me at alex@investorstream.com.au. I should note a lot of you have already taken up that opportunity, and I really appreciate you for doing that. You can also download a copy of the presentation by navigating to the handouts pane in the control panel. The presentation, I understand, has also been lodged on the ASX. You can download it from that platform as well. A copy of the webinar will also be available on Happy Valley's website and associated platforms later today. But for now, I'd like to throw it over to Greg, who's going to kick things off for us. Greg, the floor is yours.
Thanks, Alex. Welcome, everyone, to today's webinar. Firstly, I'll take you through what Happy Valley's business is about and how our strategy has evolved over the last 12 months, followed by a recap of where we're at with the project, and then an update on customers, ESG, and then lastly, what we're currently focused on. But firstly, just a few points on what we're doing. Happy Valley is building a world-class nutritionals manufacturing facility in Otahonga with the objective of being the best at producing customised nutritional products derived from different types of liquid milk and ingredients for our B2B customers. We've also moved away from focusing on infant milk formula initially, given the current challenges presented in these markets. We still plan to target this and other age group segments in the future. There are key macro trends that I'd like to point out and what the opportunities they present to Happy Valley. Firstly, in the human nutrition market, as global economies become wealthier with higher levels of disposable income, demand for healthier nutritional options is growing. The overall human nutrition market is believed to be at $465 billion a year and is growing at 6.6 annually. A natural constituent in bovine milk offers rich base loadings of vitamins, minerals, proteins, fats, and carbohydrates and other trace minerals, which makes milk a very good base ingredient for nutritional products for this human nutrition market. And not unexpectedly, dairy ingredients market is expected to grow as well to $71.5 billion by 2027. In terms of what does this mean for Happy Valley and what are the opportunities it is pursuing? Well, firstly, we are pursuing products or nutritional products that go into large markets, but are made up of a mix of dairy and non-dairy ingredients to serve applications that would typically use standard whole milk and skim milk powders. With long-term whole milk and skim milk prices likely to stay high, there is opportunity for substitution ingredients at lower price points, higher gross margins, but still achieve the specific functional requirements for these end products. Some examples of these end products are yogurts, sports drinks, confectionery, and various on-the-go snack bars. The second area of focus is nutritional formulations at the premium end of the nutritional market. These products could be across a wide range of demographics from pediatrics to adult and geriatric applications. An example of these products might be a micronutrient product that has specific immune system responses, for example. Happy Valley's facility is designed with these two opportunities in mind, along with the adoption of pharmaceutical grade finishes and standards, making it one of the most flexible plants in New Zealand. Our state-of-the-art facility is located in Otahonga and is within New Zealand's largest milk producing region of the Waikato that produces 5.2 billion litres of milk annually. Happy Valley requires 150 million litres of milk annually, which represents 3%. The company has all of its consents in place for the construction and operation of the facility. Complementing the design of the process plant itself is the major step change in ESG credentials comparatively to other dairy and nutritional processing plants, which I'll touch on later. To put all of this into perspective, the company has also signed up 3 customers, which validates our strategy and business plan modelling. With our first year revenue projections to be at 100 million New Zealand dollars, ramping up to 325 million over time. Since the IPO in January 2020, and despite the COVID lockdowns, the company has made significant progress. While the lockdowns hindered some activities, the company continued to progress areas of the plant and utility design, particularly around energy and water use. We acquired the outstanding properties for the purposes of irrigation and gained Overseas Investment Office consent late last year. We're now working through the details of the construction contract, ready for award with our preferred vendor, GEA, subject to funding. In December 2020, the company commenced earthworks to realign the entrance road from the state highway and prepare the foundations for the spray dryer and associated buildings. It's pleasing to report this is on track and on budget. We are planning to recommence earthworks later this year. We're also planning approximately 18 months for the construction of the facility once commenced, and then another 3 to 4 months post-commissioning before we generate commercial sale of product. While we have the infrastructure for the site ready to commence construction, the focus for the company at the moment is in two key areas. Firstly, securing further strategic customers to bring our annual capacity commitments to around 50 to 60% for the first 3 years of production. We're making great progress on this front, as announced earlier in the week with our third conditional contract. Secondly, we're focusing on securing funding for the construction of the facility. These two photos show the before and after state of the site. The photo on the left was a bare piece of land late in 2020, and the photo on the right is today. After securing the convertible note and loan from Merrick's earlier in the year, the majority of this funding went into direct capital expenditure on the land and earthworks, which has significantly de-risked the execution of the project, particularly relating to geotechnical issues. This is an area where it can cause budget blowouts if it isn't defined early in the project, which we've done. Here's a photo montage of the facility when complete. This facility has a large warehouse, 11,000 square metres roughly, milk reception. It's been master planned for a second dryer in the future, along with the ability to expand the store to include consumer packing in the future. All of our management plans, including landscaping and visual amenity, has been approved by the council, which actually is great because now we can start when we're ready. If I just draw your attention to the diagram on the right-hand side, in 2020, New Zealand dairy commodity exports was 12.2 billion. In addition, there was 1.1 billion of infant formula products exported from New Zealand. And then there is specialty and non-dairy products, which are harder to track as they overlap dairy and some non-dairy statistics. But we estimate these to be small comparatively. But we know these products are growing globally from the interactions we've had with our customers. These include products that may have a low proportion of dairy and have products like vegetable oil or maltodextrin as a replacement to dairy products. As I mentioned earlier, there are 3 key points to make in reference to the diagram on the right-hand side. Our plant will have capability to manufacture these customised products that are not traditionally in the dairy category and contribute to a higher margin. Secondly, we are operating in a space that will grow over time as substitutes to whole milk and skim milk powders continue to trend. And 3, we offer our customers new product development opportunities to customise their products that cannot be easily manufactured on currently available infrastructure. We have listened to our customers and designed our plant to be nimble, can take a range of ingredients and manufacture them to cater to a growing demand globally in an efficient manner. This also allows Happy Valley to start up the value curve, as indicated on the left-hand side, without getting trapped as a commodity producer requiring large quantities of milk to fill the plant in order to achieve the cost recoveries. Halfway through 2020, as New Zealand came out of lockdown, we focused on acquiring customers. We made some really good progress with many customers in the back half of 2020 and really started to make tangible progress in the first half of 21. In June of this year, we announced 2 agreements and a third this week, as I indicated earlier. The capacity of the spray dryer is normally 35,000 metric tonnes per annum of powder production, plus an anhydrous milk fat plant with a capacity of approximately 6,000 metric tonnes per annum. Currently, we have 34% of the spray dryer capacity and 50% of the AMF plant contracted, subject to conditions relating to building and commissioning the plant. We have carried out a comprehensive financial modelling for our business plan split across a range of products that we're targeting, with the aim of a break-even on an EBITDA basis in the first year of production, which has been the commissioning year, with a ramp up to year 4 with an EBITDA of approximately 15% of revenue. From year 5 onwards, We are planning to install a consumer packing plant, which will have a cost of approximately $40 million New Zealand, but allows the business to realise higher margins, with revenue projected to increase between 225 million and 325 million New Zealand, with an expected EBITDA of between 19 and 25% of revenue. Importantly, these figures are based on a range of assumptions and outputs from our modelling, which are subject to change. I should also point out the site has been master planned for a second dryer to be installed. This requires additional capital and has the potential to improve revenue and EBITDAs. However, this has not been included in these numbers. A big differentiator in our view is our ESG credentials. Dairy processing is traditionally a large user of thermal energy and water. Regarding thermal energy, this is a large part of the process to help with the evaporation of water from the milk. In the South Island of New Zealand, most dairy factories still use coal. In the North Island, natural gas is the predominant fuel source. And whilst our factory is on the main natural gas line and will have access to natural gas, we're on a path to zero fossil fuel use. And we're doing this through three key initiatives. Firstly, we recycle as much thermal heat as possible within the plant via the use of heat recuperators and heat exchangers. Secondly, we're using electrical energy wherever possible. And thirdly, we're implementing a pipeline of renewable energy initiatives to feed the factory, starting with a 4-hectare solar array on our farms. With regard to water, there is approximately 87% of it in milk, and it's a valuable source of water. We designed the plant to utilise this excess water by recycling it through reverse osmosis plants to generate high quality water, which can be utilised in the process for cleaning and other uses around the site. We also have a pipeline of initiatives to enhance the ecology around the facility and to improve the health of the Waipaha River, and at the same time, increase the utility of our company's farmland. We are working with iwi and Regional Council on a robust plan to reduce nitrogen and phosphorus leaching, while at the same time we're planning to plant in excess of 150,000 trees. This project will also have a profound impact on jobs within the local community, with over 300 people on site during construction and at least 80 full-time employees once the facility is operational. The direct and indirect job creation is significant for the town of Otahonga and the surrounding regions. So there's been significant progress and value creation over the last 12 months. I guess the key areas we're focusing on right now, however, is around securing our funding for the commencement of construction. We have a budget of 300 million New Zealand dollars, and we're looking at a combination of debt and equity. We have engaged advisors to assist the company in this regard, and discussions are ongoing. We've also engaged with many farmers on the subject of milk supply, and we plan to commence procurement of milk once we secure our capital. In the meantime, the company continues to progress discussions with customers, and our earthworks on site will recommence later this year. That brings me to the end of the presentation, and I'll hand back for questions.